Steve Sosnick here with today's Interactive Brokers Midday Market Update for Thursday, October 8th, 2020. Another day, another rally. The markets definitely appear to be in love with the idea of stimulus, despite the evidence to the contrary that it doesn't appear to be imminent. But in the meantime, why let the facts get in the way of a good story? And so, on we go upwards. There are some actual good stories out here. The idea that Lilly and Regeneron could get emergency approval for their drugs is good news on the COVID front. All good news on the COVID front is good news. What I would say there is that, this is another one of these situations where it applies mostly to very sick patients. And, I don't know that it changes the people's risk reward calculus about illness or health. If you have to wait till you're in the hospital very sick, I'd rather, really not put myself in a situation where I get to that point. So, it's good news, but doesn't really move the needle. I actually really do think one thing that's been left unspoken is that given the president's, apparent speedy recovery from COVID, or at least his perception thereof, that I think you've taken lockdowns off the table. Even New York, passed on the opportunity to do lockdowns in certain neighborhoods when they could have. So I think that is an element in there that regardless of whether people want to take them up on it or not, the idea of a further lockdown seems off the table, at least at a national level. We'll see about that. That is probably part of the good backdrop. One of the other narratives you're really hearing is that markets are getting comfortable with the idea of a blue wave. Let me remind everybody of the conventional wisdom going into the 2016 election was that Hillary Clinton would be good for the markets and Donald Trump would be bad for the markets. That narrative lasted pretty much only up to the open on the night after Election Day, at which point the markets started to move higher. Markets get this stuff wrong. Now, because markets are so fixated on the idea of stimulus, the thought would be that if you had a Democratic sweep where they have the House, the Senate, and the presidency, that more stimulus would be forthcoming and you'd have a more stimulative environment in that sense. Okay, that could very well be the case and probably is the case. And I would suspect that, since Congress gets back into session before the president is inaugurated, under that circumstances, you would have the House and the Senate working on a stimulus bill that could be signed quite quickly by any new administration. Okay, I'll grant you that. In the meantime, if stimulus doesn't happen between now and then, things will get worse before they get better. That was very clear in the Fed minutes yesterday, and that was a market factor for probably a good 5 minutes or so before it was ignored. Because again, the markets are just so fixated on the idea that this could happen. It's a little backwards, I think. Actually, I think as the president gets further behind in the polls, I think his incentive to do something, you can argue whether his incentive to do something increases or decreases. It's not clear to me that being behind in the polls would make him more likely to try to hand people money, but we will see. And the Senate really has been the sticking point on that anyway. And I think at this point, Leader McConnell sort of wants to stay out of the fray. So I mentioned the other day that a friend of mine who's a political consultant put the odds at 40% when I spoke to him over the weekend that we would get stimulus. By the way, 40 is less than 50. And it's not clear that those odds have improved at all in light of the recent comments. So let's take it from there. So if you're looking down the road for your stimulus, that means things get worse before they get better. And so I know markets are discounting mechanisms, but that's where you have to think. Also, there's other factors that come out. You're pretty much assured of if you get this stimulus, you get higher corporate tax rates and you have the potential for higher capital gains tax rates. If either of those narratives starts to really take hold, that is not, neither is market friendly. Basically, a corporate tax increase reduces the E that goes into PE equations. One would, if you think that, if markets can continue to just zoom along and not care about multiples, which they do, which is really the case for certain of the biggest market leaders, frankly, well then, okay, fine. But if not, if you're an evaluation point of view, that makes stocks more expensive. That's definitely a headwind. And do consider the idea that if the narrative turns and becomes one of a capital gains tax increase, you will have taxable investors looking to lock in gains in some of their winners. The problem is those winners are the largest cap stocks, and if people start to sell those stocks, again, all thick trades happen at the margin, you could get into some trouble. In the meantime, the market seems bulled up, risk on, loving the idea of stimulus, and it's hard to fight, and I don't necessarily recommend doing so at the moment. It's hard to fight the tape, but you better know where your exit points are. You better know where your hedges are, because this rally sort of seems built on hopes for things that don't necessarily bear out in reality, and those can be very tricky situations to trade against and trade on. Oh, and by the way, earnings season starts next week, so let's see what the companies have to say. I suspect that the analysts will be so quick to get it. Expect the analysts won't get it as wrong as they did. Although, to be fair, McDonald's surprised today. IBM finally spun off the divisions that everybody thought they might. Morgan Stanley surprised us. So there is potential for good news out there, but just be careful why you think the good news is out there, and react to the stuff that's real good news, not just hoped for good news. Have a good one.